When people think about war, they usually imagine something contained, a conflict happening in one place, affecting mainly the countries directly involved. But that's not how the global economy works anymore. Today, everything is connected through systems that move constantly: energy, goods, capital, and information. When one part of that system is disrupted, the effects don't stay local, they spread. That's why a conflict like the Israel-Iran war matters far beyond the region where it's happening. Economically, the impact starts almost immediately, and it usually begins with energy. A significant portion of the world's oil supply moves through a narrow passage known as the Strait of Hormuz. When there is any threat to that route, whether it's actual disruption or just the possibility of it, oil markets react. Prices rise not only because supply might decrease, but because uncertainty itself becomes a cost. Companies, governments, and traders all start adjusting their expectations at the same time. As oil prices increase, the effect spreads quickly. Energy is a core input for transportation, manufacturing, and agriculture. So higher energy costs push up the price of moving goods, producing materials, and even growing food. This is what economists call a supply shock, but in practical terms, it simply means that inflation starts to rise again, even if demand hasn't changed. The disruption doesn't stop at energy. Global trade depends heavily on predictable shipping routes, and when a region becomes unstable, logistics become less reliable. Goods may still exist, but delays, rerouting, and higher insurance costs make them harder and more expensive to deliver. Over time, this reduces efficiency across the entire system. At the same time, financial markets begin to adjust, often before the full economic impact is visible. Investors don't wait for outcomes, they react to risk. When uncertainty increases, capital tends to move away from riskier assets and toward safer ones. This shift can tighten financial conditions globally, making it more expensive to borrow and more difficult for businesses to invest or expand, even in countries far removed from the conflict. What makes the situation more complex is that the region itself is not the largest contributor to global economic output. In terms of total GDP, it represents only a portion of the world economy. However, its importance comes from its position within the system. Control over key energy routes and production means that even a localized conflict can have disproportionate global effects. The result is usually not a sudden collapse, but a gradual shift. Costs rise, uncertainty increases, and economic decisions become more cautious. Companies delay investments, consumers reduce spending, and growth begins to slow. At the same time, inflationary pressures can persist, creating a difficult environment for policymakers who are forced to balance slowing growth with rising prices. Even if the conflict were to end quickly, these effects would not disappear immediately. Prices, once adjusted, tend to remain elevated, and supply chains that have been disrupted often take time to stabilize. Financial markets, having already repriced risk, do not simply revert to previous conditions without a sustained period of stability. In that sense, the long-term impact of the war is not just the immediate disruption, but the way it reinforces existing weaknesses in the global economy. Many countries are already dealing with high debt levels, slower growth, and lingering inflation. A conflict like this doesn't create those problems, but it makes them more pronounced. What's important to understand is that modern wars are not only fought through direct confrontation, they also move through systems that most people interact with every day, often without noticing. The effects appear in prices, in delays, and in the general sense of uncertainty that shapes economic behavior. By the time those effects become obvious, they have usually been building beneath the surface for some time.